Imagine a machine operating on a scale so massive it almost defies human comprehension, right? We're talking about a financial engine that powers global innovation, builds monumental fortunes, and literally shapes the economic realities of everyday Americans. It can definitely seem intimidating from the outside, shrouded in complexity and towering glass buildings. But underneath all of that, the mechanics are actually surprisingly elegant. In this explainer, we're going to strip away all the noise and completely demystify the US stock market.
Just look at that word for a second. Trillions, with a T. Every single day, trillions of dollars move through the US stock market. It's just a staggering amount of capital flowing back and forth across the global economy. And yet, the core foundations driving this unimaginable wealth, they're built on concepts so straightforward you probably encounter them in your everyday life without even realizing it.
Because really, that's the big secret here. Over the next few minutes, our goal is super simple. We're going to distill the mechanics of the US stock market into a clear, unified framework. We are cutting straight through the confusing Wall Street jargon to give you the pure, structural fundamentals that drive real-world wealth.
So here's our roadmap for today. 1. Anatomy of a stock. 2. Exchanges and price action. 3. How investors actually profit. 4. Managing the inevitable risks. And 5. Rules of the game.
All right, let's dive right into part 1, anatomy of a stock.
Okay, picture this. You own a fantastic, small, local pizza shop. The community absolutely loves it, business is booming, and you're growing fast. Naturally, you want to expand, maybe open 3 new locations across town. But expanding costs a lot of money. Now you could go to a bank and take out a massive, expensive loan. Or, instead of taking on all that crushing debt, you could decide to sell small ownership pieces of your business to investors to raise the money you need.
Well, those tiny ownership pieces you're selling, that is exactly what stocks or shares actually are. When investors buy your shares, they literally become part owners of your pizza company. And this is exactly how massive public companies raise capital. By buying a share, an investor is tying their own personal financial success directly to the future growth and profitability of that business. Now, you might be wondering why prices bounce around so much. It's because buyers and sellers are continuously reacting to new information. If investors expect a company to earn more profits, demand increases and the stock price rises. But if expectations drop because of weaker earnings, economic concerns, or totally unexpected global events, demand decreases and prices fall. The market is just a real-time reflection of millions of these little decisions every single trading day.
Moving right along to Section 2, Exchanges and Price Action.
So in the United States, there are 2 major stock exchanges that you'll hear about most often. First up is the New York Stock Exchange, or the NYSE. This one's generally known as the home for many of the world's really large, historically established companies. Then you have the Nasdaq, which is famous for housing a massive amount of technology and growth-focused companies. But honestly, fundamentally, both of these exchanges serve the exact same purpose. They're basically just highly efficient platforms that help buyers and sellers trade shares with one another.
Section 3, how investors actually profit. All right, the million-dollar question. How do these mechanics actually build wealth? Well, there are 2 primary avenues for an investor to earn returns in the stock market. The first path is known as capital appreciation, and the second is through something called dividends. Let's break down exactly how both of these work.
So, capital appreciation is the concept most people are probably already familiar with. It's a fancy term, but it simply means the value of your share went up. For example, if you buy a stock today for $100 and the company grows and becomes more valuable over a few years, you might later sell that exact same stock for $150. That $50 difference, that is your gain. You capture the appreciation in the company's capital value.
The second way to profit is through dividends. Sometimes, a company makes a really great profit for the year, and they decide to share a portion of that directly with their shareholders through regular cash payments. That's a dividend. It is literally cash deposited right into your account just for holding the stock. Pretty cool, right? However, keep in mind that not every company pays them. Fast-growing businesses, especially those tech companies on the Nasdaq we mentioned earlier, they often prefer to skip dividends so they can aggressively reinvest all their profits back into expanding the company.
Part 4, managing the inevitable risks.
Okay, time for a reality check. This is a fundamental truth you absolutely must accept. The stock market does not move in a straight line. Prices can rise quickly, sure, but they can fall just as fast. There is absolutely no guarantee of profits, and every single investment carries risk.
This is exactly why experienced investors tend to ignore the crazy short-term market swings and focus instead on their long-term goals and the actual underlying value of the businesses they own.
So how do smart investors protect themselves? One word, diversification. Think back to our pizza shop for a second. If you take your entire life savings and dump it into just that one single shop, and it struggles or fails, well, your investment is wiped out. Diversification just means spreading your money across many different companies or entirely different industries to significantly lessen the painful impact if one single investment happens to perform poorly.
And finally, Section 5, Rules of the Game.
You know, the most successful investors aren't just blindly trading based on whatever flashy headline happens to be on the news today. They do the work. They research. Public companies are legally required to regularly publish their financial reports. And smart investors, they dig right into these reports to study the actual financial results, the leadership's business strategies, the inherent risks, and the true long-term growth potential before making any kind of informed decision.
Now, ensuring that those companies are actually telling the truth in those public reports, that's the job of the SEC, or the U.S. Securities and Exchange Commission. You can kind of think of the SEC as the market's referee. They're a government agency totally dedicated to enforcing securities laws to protect everyday investors like us and to promote fair, orderly, and transparent markets. But remember, and this is key, while the SEC fiercely enforces the rules of the game, they cannot ever guarantee that your investments will be profitable. That part, that is entirely up to you and your own research.
As we wrap up this explainer, I really want to hammer this point home. The U.S. stock market is not some get-rich-quick scheme. It's a marketplace where true, long-term ownership in living, breathing businesses is bought and sold. The more you understand these fundamentals of how companies, risk, and long-term investing truly work, the better prepared you're going to be to follow the market with absolute confidence. And as a quick reminder, while we absolutely love demystifying these concepts for you, this explainer is strictly for educational purposes and isn't financial advice. Always, always do your own thorough research before making any financial decisions.
Well, you've got the clarity now. You can look past all that confusing jargon and see the market for what it really is, a tool for scaling businesses and building long-term wealth. The trillion-dollar machine is no longer a mystery. So, the only question left is, now that you understand the true mechanics of wealth creation, how will you approach your own financial future?